All right. So, welcome back to week 7 of Mastering Money Management with Urban Forex. Now, this week we want to talk more about on how to exit properly. Now, last week we discussed how important exits are. We ended the week like that to let you guys know that it is a very vital piece, just like your entries. But this week I want to talk more about how to do those exits properly. Now, I know this is now getting more into the technical side of things, but I need you to bear with me and try to understand. We have a lot to cover this week, so we're going to go into it piece by piece, step by step. Again, it's going to get technical, so take notes. Again, this course is obviously available for you, so you can rewatch it as many times as you need, or come back to it when the time is right, because exiting is not something that should be mastered or focused on if the entries are wrong. Okay, so I'm gonna sort of touching base on what we talked about last week. I'm gonna talk about it a little bit on this week. Okay, so last week I mentioned to you guys about how to measure between when you enter and if you got the right price, between how much it went against you. And same thing with exits. When you exit, how much further did it go after you exited, and if you should have held on for that long, and so on and so forth. So just to give you a brief explanation on that, and let me show you on the charts here. Okay, here we go. Okay, here we are. Now, in this particular example, we're just on Aussie Japanese yen. This is the 15 minutes. Just assume this is your trading time frame, whether you're a 1-hour trader, the 4-hour trader, the daily trader, whatever it may be. Assume this is your trading time frame. Okay, again, it doesn't have to be Forex. It can be futures, options, cryptocurrencies, you name it. Okay, so let's say you come to this chart, and as a, for example, a trend pullback trader, you might be looking at this as an uptrend that came in, and let me get the marker out. So you're looking at this as an uptrend that has come in, and you're saying, obviously, I don't want the price up here. Give me a better price, and I will consider getting in. Okay, you might have gotten somewhere around here based on your research, whatever the research may be. Just as an example, you might have gotten here, stop loss down here, and then as the markets went up, you're like, not yet, I'm not going to exit yet. It came back down very deep. You're like, whoa, what's going on? Went up, started to struggle, and then you exited. Now, here's the important piece of what I explained last week. If at the moment of exit, you go back to your post analysis just a matter of 2 candles later, and you do the research, or 3 or 4 candles later, and you're like, oh, look at the price right now, it's over here. I think my exit was good. I think my entry was good because the trade went against me maximum 1 pip, and once I exited, the trade never went against me. Okay, so it was a good exit because after that the markets crashed. So you might come to that conclusion if you do your post analysis very quickly, but later on, if you actually did this after giving it a session in between, you will notice the correct entry was not there. It was supposed to have been much later on, somewhere in this area or this area, because then the markets actually tend to progress after that. Okay, so this would actually, if you do your post analysis incorrectly, it will give you the wrong information, and it might make you practice incorrectly. Okay, so this is very important. This is very, very important. So now a couple of things that I wanted to discuss this week, right? So this is just a little touch base, just to touch base on what we discussed from last week, and why it's important to give it that little time space to let the trade have some more data, so you can know, did I actually do what I think I did right or wrong? How is my edge performing? Okay, and how am I adjusting to my edge, whatever the edge that may be. Now, so this whole week is all geared and focused around exits. Okay, exits are all about risk control, and it's all about making money with risk control. Okay, so again, it's risk control, making money with risk control. Okay, so it's not about making more money. I'm going to teach you techniques on how to make more money, but at the same time, you cannot make more money on the back of on the shoulders of risk. Okay, that's not the correct way to do things. You cannot put the weight on the shoulders even more for the sake of making more money. That's the incorrect way to do things. Okay, so I'm gonna go into that little detail here, because many people, when they go into scaling in and stuff like that, they tend to double up, triple up, and stuff like that. This is more of an issue with the aggressive traders. They go in bigger, they go in more, and that's not good. Okay, that's not good. And we discussed the different schemes several weeks ago on what shape should you be scaling in and stuff like that. Okay, so let's proceed to the next video, and I'm going to walk you through on what it means on how to maintain your profits while still controlling your risk.